Bim. Folks, it's Nick Masunda here, video number 8. I'm going to be talking about concessional contributions in this one and how they can save you tax money, which is something we all like to do. So definitely watch this to find out a couple of tricks of minimizing your tax with concessional contributions to superannuation. Okay, so I'm going to start by just covering off a couple of the basics. I'll show you how income tax works, how tax in superannuation works, and then ways of reducing tax. That's basically going to be the plan for the video. A couple of potholes to look out for as well. So firstly, income tax. The way it works is whatever your income is, that'll determine the amount of tax you owe to the ATO. And it's based on these tax brackets, okay? So you can see here, as an example, if you're making, well, any dollar you make between 45K and 120K, you're going to pay 32.5% on every dollar. If you were making 120K, you would pay $29,467 in tax. So your take-home amount, the amount that ends up in your pocket, is going to be about 91K. All right, that's just 120 minus 29. If you made 180K, you'd be paying $51,667 in tax. Any dollar above 180K that you made, you'd get charged 45% on each dollar. So that's income tax. Just really quickly, there is a Medicare levy of 2% that's charged on every dollar that you earn. So effectively, these marginal tax rates go up 2%. So 34.5, 39, 47, etc. Okay, so that's income tax. So any dollar you make outside of the superannuation environment gets taxed at those rates. Now, any money that's contributed to superannuation gets taxed at a flat rate of 15%, with a few exceptions. But generally, 15%. It's a flat tax rate, okay? Which, as you can see, 15% is less than most of those marginal tax rates that I just mentioned on your income tax rates. So, yeah, that's the first key point to take note of. Now, when you're an employee, you're receiving a salary, your employer is obligated to pay 11% on top of your salary to your superannuation. All right, it's called super guarantee payments. And then those super guarantee payments, because they're getting paid into the superannuation environment, they get taxed at 15%. So, yeah, if you pay 10K into super, 15% of that goes to the ATO, you end up with $8,500. All right, so that's just a quick overview of income tax and super contribution tax. Now, to sort of illustrate this, I'm going to give you a quick example. So let's look at a hypothetical person here making 150K. Now we're going to assume for this example that that they don't have any tax deductions. So their super guarantee payments are 11% on top of the 150K. That's 16,500. No additional concessional contributions. So taxable income is 150K. So income tax plus Medicare levy on 150K is 43,000 odd. The 15% contribution tax of this 16,500 that's going into super is your 2,000 odd there. Total tax, $46,042. All right. Now, you have the option of making extra concessional contributions to superannuation if you want to. Okay? And the benefit of doing this is that it will reduce your taxable income and increase your super contributions, right? Now, you will pay less tax when you do this. Let's look at a quick example. We go back to our hypothetical here, scenario 2, $10,000 additional concessional contributions to super. So your income's still 150K, nothing changed there. Super guarantee payments, 16,500, that's the 11%. Nothing's changing there. That's going into superannuation. But you're adding an extra 10K into super in this example. So your taxable income's gone down by 10K. All right, so tax and Medicare levy is now based on 140K. So this figure has dropped. It was 43 odd before, 1,000. It's now 39,000 odd. your contribution tax has gone up because you're putting more money in super. Now you're putting in 26,500 rather than 16,500. So the contribution tax has gone up to 3,975. Before it was 2,475. Right? Now, this is what's important here, the net amount of tax being paid. The difference between these two figures is 2,400. So you've made the exact same amount, 150K, but because of this extra $10,000 that you've contributed to super, you've saved $2,400 in tax, right? Which is pretty substantial. Like if you were to do that every year for 10 years, without making any more money, your net position is going to end up being $24,000 more, all right, without doing anything. But now, if you, I mean, I guess like if you were to just put the money in cash and put it under your bed, right? No earnings. But if you were to say invest that and get a 10% annual return on it, I did a quick little model here to show roughly what the difference in your two positions would be. Now, just keep in mind here, I didn't include any tax on the earnings in this model, so it's not going to be accurate, but it'll give us a rough idea of the difference in the two scenarios. So scenario one, that was where you're taking the money, the $10,000, and you're investing it outside of superannuation. So it's effectively investing $6,100 each year. And this is the hypothetical person who's on 150K. If they invest it inside of super, because it's just 15% that they pay in tax in that case, it's 8,500 that they are able to invest each year. And again, didn't include any tax on the earnings, but if you look over a 10-year period, so just to quickly explain what's going on here, so this is the year, this is your annual contribution or investment, this is your earnings plus previous year's balance and end of year balance. So end of year balance after cumulative end of year balance after 10 years outside of super, 97K odd, right? Inside super, 135K odd. Difference, about 40K. So if you look at the outside of super as your base case, you made about 100K, you're making about 40K more when you invest inside of super. That means it's about a 40% increase in your final position, okay, which is pretty compelling. And this difference is actually going to be larger when tax on earnings is taken into consideration. The difference will be larger. Both of these figures will actually go down because you're getting some tax on earnings, but because of the differential in the tax, this differential here is going to be bigger after 10 years. So even more so compelling. All right, so yeah, that is why some people like to make extra contributions to superannuation. Okay, because the difference in your final position can be pretty compelling. So if you decided that you didn't want to do that, you'd probably want to have a good reason for not doing it, which is typically going to be, I need the money earlier than retirement, because if you've made that contribution to super, it's in super, it's locked up until you meet a condition of release. You know, typically it's just going to be retirement age for most people. Or you maybe have some investment in mind that you think is going to return you better than what you could invest in super, right? Like in some sort of boutique investment option that you can't access through super. That would be another reason why you might want to take the tax hit and invest outside of superannuation. So that's what you need to take into consideration. Okay, now this is something that not everyone's aware of, but any unused, well, actually, I need to explain the concessional contribution cap. Okay, so concessional contribution cap. Now, you're looking at this example. You may go, well, look, I've got all this cash. I want to put in not just 10,000, but I want to put in as much as I can every year because I want to get that 15% tax rate. I don't want to be paying my marginal tax rate on the dollars I'm earning. Issue with this is there is a contributional cap. The contributional cap is 27,500 currently, and that is the max that you can put in of concessional contributions in this financial year and financial years moving forward. So in our hypothetical example that we just looked at, the super guarantee payments were 16,500. the additional concessional contributions of 10,000. So that's a net amount of 26,500. This person is already $1,000 away from hitting the cap. Any dollar they contribute to super after they hit the cap is going to be taxed at their marginal tax rate. So there's no tax benefit there any longer. Okay, so that's something to be aware of. Now, there is an opportunity to do what is called catch-up contributions. Not everyone is aware of this. Catch-up contributions is where you will take advantage of any unused concessional contribution cap from the last 5 financial years prior to this current financial year. All right, prior to this current financial year. So I'm just going to put up a quick example of what I mean on the graph so it's sort of clear. So if you look here, this is the last 5 financial years. Our hypothetical person here is, let's say they were just doing their super contributions. They didn't know anything about adding extra concessional contributions the last 5 years. 16,500 super guarantee payments every year. Now these are the concessional contribution caps in each of these financial years. You can see that financial year 19, 20, 21, it's $25,000, and 22, 23, it was 27,500, the same as it is this current financial year 24. So any unused cap is simply the difference. So in this year, 25,000 minus 16,500, it's out to 8,500. And that was the same for the next couple of years, and then it's 11,000 for the last couple of financial years. You add all this up, and that is your catch-up contributions from the last 5 financial years. You can contribute that to super and get charged the concessional contribution tax rate, 15%. So this basically gives you a pretty substantial tax deduction. Okay, so popping this back in the example over here, same hypothetical person, 150K, 16,500 in concessional contributions, and now we're going to add that 47,500 plus the 10K. So that's what your taxable income drops down to. So your income tax plus Medicare levy is now this much. Contribution tax has gone up substantially because we're now putting in 57,500 plus the super guarantee payments. Net amount of tax paid is about 33,000. Okay, so if we compare this to our base case, which was where we were doing no additional concessional contributions, the only money going to super was the 16,500, the super guarantee payments that our employer was making. So if we do that comparison, we are saving $12,563 in tax. Okay, so yeah, there you go. If you've got a lump sum of cash that you want to invest, and you want to also get a pretty substantial tax saving that financial year, this is a trick to doing so. Now, a couple of things you have to be aware of here if you want to take advantage of this strategy, and always get some personal advice. Always go to talk to a financial advisor, a tax professional, accountant, whatever. All those disclaimers, but you need to have a balance of 500K or less in super. If your balance is higher than that, you can't take advantage of catch-up contributions. Okay, you can still do concessional contributions each year under the cap, but you can't take advantage of the last 5 years of catch-up contributions of unused cap. The other thing is, if you're doing these additional concessional contributions, then you will have to let the ATO know that you want to get the concessional tax rate. All right. Otherwise, they won't know, and the money will go into your super post income tax, post those higher marginal tax rates. So you've got to fill out an S290 form. Generally, you provide that to the super fund, and they'll process that for you. So yeah, just something to be aware of there. But otherwise, that's pretty much it, guys. That's what I'm talking about. That's how you save money on tax with concessional contributions. Thanks for watching.